Alright, as per the request of Mr. Whacked Media, he asked us to give a breakdown on what are some of the typical creative accounting tricks that people or companies might use to mislead investors. Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description. Right? Sometimes it's not even an intention to mislead, it's just a technical term, and people misunderstand those technical terms, and so sometimes they feel misled when actually it's a normal term that everybody use, right?
These companies basically, they are playing around the rules that is incorporated by the SC or the Bursa lah. So technically speaking, it's not really illegal. But thanks for the suggestion. So if you guys got any more video type of suggestion, please do comment in our videos so that we know. All right. So
yes, we have about 4, right? So we will start off with this thing called fake earnings. So
yes, so you can see over here, this is Next G, the next generation, or previously Datasonic.
The name is already
you can see that their profit is at its all-time high. So if you see this star over here, which means historically, this is the highest amount of net profit they have generated. And if you look at the historical or preceding quarters, the profit is actually growing at a linear curve over here. And right now, you want to see whether this profit, whether is it really that good or not. And you can look at their net margin is about 73.3% compared to like previously they make about 33%. So it's a remarkable increase. So number one, fake earnings. You can read more about these companies in their quarterlies itself. So number one, you want to look at their income statement. And if you want to see whether this company is truly making a profit, you just straight away look at their other income. If their other income has a max boost, right? Big jump, right? So that tells you that this company's earnings is not coming organically. It's probably means they're selling something.
So to be precise, I think some of you all may misunderstand what fake earnings, what Jonathan's trying to say about fake earnings, but it's more like from operations, right? Or organically.
It's a once-off.
That's the key, yes. So do not be misled by this. And of course, more important is to investigate what is that other income.
Yes. So if you read even further into their other statements, like cash flow statements, you notice this thing called the fair value gain on other investment. So it's just like on paper, they show you that the unrealized profit increased, so they need to do
but by law, they have to report this. So a company that has a similar issue is a very big company, which is Berkshire Hathaway, right? So when their stocks go up and down, the SEC in the US insist that you have to put it down under the profit and loss statement. So that will make the earnings of the company very choppy. So something similar is happening here.
Yep, exactly. So that's why this is nothing to do with their own operations. It's to do with their asset that managed to make even more profit, unrealized profit. So that's the first one, fake earnings. The second one, which is kitchen sinking. I think this one, a lot of people don't know about this, but to simply explain, during very bad times, right? Or let's say the company know that they're going to be announcing very bad quarter numbers. Usually it's like losses or something. So they want to put all the bad news into this one particular quarter. So whatever thing that they can tell you guys, which is, let's say there's some sort of impairment in receivables, there's like bad debt, there's like impairment in inventories, everything, they'll just lump it into this one particular quarter. So that, once all of these bad news is already priced into this one quarter, the next quarter will be looking even more better. It's simple as that only. So one company that we can see over here, which is Dialog. So in quarter 2 2025, we did a video about this also, so you can just watch it over here. Essentially, they made a huge loss, and mind you, Dialog is a very steady business. They are in the rental of their storage for oil and gas, so it's very rare to see they make losses. It's very hard to fathom about that. So a lot of investors, when they saw this loss making, right, they panicked and they actually sold. That's why if you see, right, there's like a share price dip a little bit over there during that particular time. And it is also mentioned by the analysts over here. Essentially, the loss in quarter for Dialog is a kitchen sinking exercise where they want to exit and write off their investment in the loss making.
So in this case, actually, it's something like a green flag, actually, for looking at companies. So of course, when you look at the losses, it looks bad, but it's actually being conservative, right? You are front loading all your issues so that you clear everything up. What you don't want is like the opposite of kitchen sinking, or the opposite version where all the good stuff
Yeah,
you're
you
gonna
put
put
it
into
in
this.
one.
Maybe because you say this quarter is going to be very good to analysts, then you force yourself to do it, right? That's the worst. So in this case, it's actually quite positive.
Exactly. And you can also see that there are comments over here. So they say that, we do not expect a massive cost overruns to recur in the coming quarters. They already
Yeah.
say that the next few quarters is going to be okay
Yeah.
already because they book every single necessary expenses into this particular quarter.
Yeah. So what you hope in this sort of situation is actually that the market overreacts, right? And then it drops a lot because, Dialogue never loses money, right? And suddenly they lose money. And so if there's an overreaction, then that's actually an opportunity for you to pick up. I think some of our members managed to grab hold of this advantage, and now they are doing better.
Yeah. So if you want to really see whether they are making real earnings or not, then you just need to check their operating activities or their cash flow statement. So you can see the numbers actually didn't really drop a lot. I mean, from 48 million to 400 million is still quite decent, even though it dropped about like 20%. But essentially, they are still making money.
Right.
So if let's say you bought during the time where they dip, like from 1 ringgit and 80 cents to about 1 ringgit and 50 cents ish, and you held it all the way until today, you will be
20%.
making a 20%. Well, we don't really include this dip in April.
That was the tariff, yeah.
Yeah, correct.
But if you did include it, I mean, if you let it run some more, right, you
can make even more, like 30-40% easily. So yeah, make sure to read more instead of just like looking on a surface number and then just make a quick decision. That's usually a bad thing to do. Okay, the third one, this one is a little bit difficult, off balance sheet items. So you're going to be looking at this company, which is called KJTS. So this company recently, they want to form a JV or joint venture, basically like a partnership with StoneSpeak to develop this thing called the cooling assets. So essentially, StoneSpeak would own about 90% of this JV, whereas KGTS about 10%. And this business, they need 1.5 billion in funding. And obviously, this is a huge amount of money. So what this essentially tells us is that KJTS might need to fork out 150 million out from their pocket. Obviously, because they own 10% stake. And from this agreement, basically what their work is, they need to be a consultant to provide technical expertise because they have been in the space, and also do some EPCC and also maintenance work. So essentially, because they are not really owning 100% of this JV, right, which means 90% of the funding will be coming externally instead of from KGTS. So which means there is some sort of off-balance sheet financing because the 100% of the financing will not be reflected inside KGTS balance sheet itself. Sounds a little bit confusing, but it is what it is. I mean, it's essentially just to tell you that this JV, you only see the 10% of the funds that's reflected inside their balance sheet instead of the 100%.
Yeah, but the key thing about our balance sheet item is that it actually affects the company.
Correct.
It's just not inside.
Yeah, the debt is not included inside the balance sheet, but the profits will be included. Yeah, so that's why you see that, if you look at their JV in the future, quarterlies, there will be a line item where they say share of profit from joint venture or something like that in their income statement. And then you see that the balance sheet itself, the debt doesn't look that big. So that is basically an off-balance sheet item. Now, the key thing you need to know is that whether they have this 150 million. So you can see their latest quarterlies, they don't really make a lot of money. They only, in profits, they make about like 8 million-ish for this particular quarterlies. Whereas for their cash, if you total this number up, it's actually around I would say, let me do a quick math over here, 50 million. Okay, so it's about like 60 million in cash. But you need to minus off these debts that they have. So net cash, probably they have about like 54, 53 million-ish, which is still quite far off from the 150 million that they need for this joint venture. And on top of that, they recently spent a little bit of money because if you follow the news, they bought Malakoff Utilities, which is another cooling asset that is owned by Malakoff for 65.5 million. So here already, I mean, they have another spending. And essentially, they are going to be using whatever money that they have inside their bank over here for this acquisition. So, which means they don't really have another 150 million for their additional JV business. So, what this also tells us is that either they need to go to the bank and ask for more money, or they may
take from shareholders.
Yeah, take from shareholders, because you will be diluted.
Yes.
Yeah, and you can also see that recently they actually did a plan, a special issue for the Bumiputra investors. So they're going to be raising about 12.5% of their shares, and the amount is going to be about like 145 million. But this 145 million, although it is like almost enough for their JV, but this money is actually not for this particular JV itself. It's actually for the Malakoff acquisition. So what this tells us is that probably in the future they will be raising more money instead of like using their whatever balance they have or their cash flow that they have on hand. So this tells us is that in the future their finance costs will be increasing, assuming if let's say they raise money from the banks, or the shareholder equity base will be increasing because they'll be raising money from you guys shareholders, whether it's through private placement, right issue, or whatsoever, or issuance of new share. But it's still going to be damaging for you guys because it's dilutive measures. So that's the third one. That one's a little bit more complicated. But if you guys don't understand, I can just comment in the YouTube. We'll just correct over there. So the last but not least is cash. So cash is actually not as simple as what people think. People thought that cash is just like whatever money that they have inside their bank balance. But sometimes that cash might not be liquid. It could be restricted also. Okay, so this is one of the companies which we shared about, or we talk about this company, MAG, in our last few videos on Camaro. So if you want to watch it, you can just click on the links over there. So Camaro, if you see in 2023 January, they raised a private placement and they need about 36 million to fund their prawn farm expansion. But what's interesting is that they have a lot of cash. I mean, if you can see, it's about 210 million in cash minus off whatever that they have. Let's say it's about 110 million. They have essentially 100 million in cash. So why do they need to raise private placement even though they have enough cash for this expansion? Well, if you are inside our FIRL team, or if you read our management notes, you'll find out that they need this private placement because a lot of their cash is actually parked inside their China's bank account. So if you guys didn't know about China, there is some sort of restriction for which don't allow you to withdraw your money for a certain time of period. So that's why a lot of money is parked over there. That's why they cannot take out money over there, and they need to find ways to raise money for this expansion. So it's simple as that. And this information, you only can get it if, let's say, you attend to briefings, because that's where the CEO will actually explain to you.
And because our members get it almost fresh out, right? So what happens is that we will actually attend these briefings. And then once we get all the data, we'll fix our grammar, we'll fix, some of the facts, make sure they're accurate. And then sometimes within 30 minutes or so, we can, just dish it out to our members.
And there's actually more management briefings. You don't see it over here, but it's going to be close to like 400 notes.
There you go.
So,
Yeah.
Okay, the second company we have over here, which is Harbour. Obviously, I think this is a company that a lot of value investors likes because of their
If you
cash.
followed us earlier in our journey, you will know this was a company we talked a lot about.
Yes, exactly. And if you calculate their cash that they have on hand, it's about
very
450
big,
million. And then their debt is about 45 million. So net cash about 400-ish million. And if you can see their dividend payout, they are paying about 40 million every single year. But this number didn't really increase. So we're going to be finding out why is that the case. So similar thing, we also attended their briefing and we found out that, a lot of their ships are actually very old already. As you can see over here, the average age of their vessel is about 24 to 25 years. And then they need to do some sort of replacement or buy new ships or maybe even replace some sort of parts. So essentially, like, assuming they have like 10 ships, right? So which means like these 10 ships might need to undergo some sort of like refurbishment or replacement, some sort of this kind of thing. And if you see, right, they also did mention that every single ship, the cost to actually replace, scrap it off and buy a new ship is around like 40 to 45 million. So simple math, assuming it's like 40 million per ship, 40 million times 10 ships is a 400 million already. And they already have like a 400 million in net cash. So this tells you that why they cannot pay more dividends is because they need to reserve some cash to actually, refurbish their ships. So it's as simple as that. And you can get this information inside FIRL as well. But this doesn't really tell you, this shouldn't be a conclusion that they cannot pay out more dividends. Obviously, if let's say they manage to make more cash flow, their cash balance start to increase a little bit more, then potentially they can pay out more dividends. But so far, this is like one of the hindrance or restrictions that is actually preventing them from paying more dividends. So that is basically the 4 accounting tricks that fools investors. But there's also other stuff that we didn't cover, which is number one, order book. I think this one is like a construction term. Essentially, program how much contract did the company manage to win.
Yeah, there's order and then there's tender.
So that's also another
important.
confusing thing. But we talk about this in our FIRL. If let's say members, they want to know about that, we also talk over that. Then there's also RPT, there's also compensation. So it's just not these 4, there's actually more into it. But maybe in the future we will decide to do like a video about it in our SIB program.
Yep.
Okay, the second one, obviously, this tells us is that there's more than just numbers. There's a lot of like accounting things that you need to know, whether is it quantitative or whether is it qualitative. So that's why investing is a very, very tough thing to do because you also need to read between the lines whether this is a good thing or is a bad thing. And then the third point is what's even harder is it's harder to actually analyze management because they are humans also. Humans behavior change all the time.
Yeah.
So yeah, today they may say this, they say
Yep.
A, but tomorrow they may say B. Then
Yep.
future they may say C.
One of the things I like to do is I like to take, about 5 years of annual report, and then I'll just upload it to AI and ask them to read the management section and ask them to track. So they're actually quite decent and quite accurate. They can tell you, they'll tell you what is said and what's the reality, what actually happened. So I've managed to identify certain companies that have poor track records just by doing this and just within a few minutes.
Yeah.
Yeah.
Yeah, so actually the key thing if you want to
Yeah.
invest in good companies is actually still their business. So this is what Manga say lah. A good business can survive a little bit
Yeah.
of bad management.
So the reason why this is true, especially with the core topic we have today in this video, is because think about why would management want to play around with accounting figures. The reason they do that is because they don't have a good business, right? If you have a good business, why would you need to play around with accounting rules? So that is one very big filter, right? Once the business is functional, is recurring, as a mode, growing, market share is big or about to become big, then you have a fantastic business, and very unlikely they will have, accounting tricks being played.
Yeah, so you can see right now Nvidia there's no kitchen sinking.
Yeah.
So it's because their business
Yeah,
is
and
booming.
if you look at the behavior of, so for example, one not to say this is, this somewhat accounting related, would be changing of year end, financial year end, right? If I change the financial year end, how does that affect the operations and all that? But companies do it. Some companies do it, every year,
Yeah.
So then straight away that something is wrong already.
Yeah,
right?
and-
You don't know what, you can't prove that it's bad, but something's going on.
Yeah. Or another simple thing is when they change name.
Yeah, when they change, that's another. I mean, there are some, like for example, when MyEG changed to Zitrix, I think those are okay because that signals a
Transition.
business. It's not like MyEG was doing bad or anything. It's trying to, or like Facebook and Meta, those are fine. But there are others, that are
Yeah, every single year change different name. Yeah,
Yeah.
something's wrong already lah. So yeah, that's about it for today's video. And we talk a lot about these fundamentals, lessons inside our
go
SIB
much deeper.
program.
We go much deeper into all of this in our SIB program. So if you've been watching our videos, we talk about FIRL Pro a lot. And FIRL Pro is designed for people who don't have so much time to do the research and they need help from us to shortcut that research journey, right? For those of you who are really interested in learning and want to actually apply some of what you learn and to do more DIY sort of investing, SIB would suit you a lot better. And it's a 50% discount for all our viewers. If you are watching this video, you will definitely get that discount. And there's another thing that I want to add. Once you become part of the SIB gang, if you choose to hop onto FIRL Pro in the future, you will actually get a 33% discount off through SIB, right? So, and if you want to pay nothing for SIB, just hop onto FIRL Pro. FIRL Pro members get it totally for free. Speaking of FIRL Pro, this is the performance for August. September is on track to do better than August. So for those of you who are really interested and to see before the portfolio grow in value, what are some of the names we have inside, do hop on to FIRL Pro. Inside, we have write-ups, we have a community to, again, as I said, help you shortcut your research journey. And to give you a taste of what it is, we have a free sample link, comment section and description. Click on it, you'll be able to see one of them is Kellington, company that I think it's one of the early companies we added into the portfolio and we do a write-up on. And a lot of our members actually managed to profit from this. So potentially you could be the next one. With that, I will see you in the next video. Bye-bye.